I got to be honest, I'm a little surprised with today's session. So coming in, I told my subscribers, I don't think we'll bounce today. If we do, it will be phenomenal, really mind-boggling. This would be like the third time we weren't supposed to rebound this quickly. I am excited and continue to be excited about buying on the dip and getting repositioned, particularly ahead of NVIDIA's earnings next week. After all, folks, we still haven't seen what we used to call classic capitulation. But, you know, I saw this chart, and maybe there's a different way of measuring it. Maybe it would be percentage decline instead of percentage decline. Maybe we should look at volume. New York Stock Exchange, declining volume. So these are the biggest spikes. You see above this red line? Every one of these spikes was followed by a massive rebound. And I got to tell you something. Thinking about that, so yesterday's declining volume on the New York Stock Exchange, folks, look at that, the highest ever. So if that's your new capitulation, maybe today's session is not so far-fetched that we've made this reversal so quickly. Again, a blue Kurtik, they put out some great stuff. You should at least follow them on Twitter. So my next guest says that he's looking at a mosaic because there are three eyes that really matter. I want to bring in Wells Fargo, the Chief Investment Officer for Wealth and Investment Management, Darrell Cronk. And Darrell, let's go over your list, my man.
All right.
The three eyes.
Yes.
Inflation.
Inflation. So we know it's been sticky at 3%, 4+ years now.
God, I'm sorry. I just forgot a question I should have asked Stephen Myron about that. Golly, I just had him on. I don't like this 2% thing. I think there should be a higher inflation. I'm sorry.
I agree. I mean, I think over time, the Fed won't admit that, right?
Right.
I doubt you would get him to admit it. But you know, we're 4+ years of not coming close to the 2.5% inflation target, right? We think it probably does push into 2026, right? Inflation has a history of increasing rapidly, declining rapidly, consolidating for a period of time, and then often re-rising. We've been consolidating for a period of time. That would surprise us.
So would this be an impediment then to a rally, a stock market rally, or would it hurt like the notion that the Fed's going to come to the rescue?
I think it will benefit certain sectors and certain areas, but I don't think it's an impediment to the broad market.
So with interest rates, how many cuts are you expecting, let's say between now and the end of next year?
So December, yes,
okay.
Right, one more, and then 2 out into next year. So you bring the Fed funds down to 3 to 3.25%, right? We think one of the highest conviction ideas in the next year is, again, the steepening of the yield curve, right? You either get the long side coming higher and the short side staying where it is, or the short side coming down even more meaningfully and the long side staying anchored. Either way, that steepness of the yield curve, we think, is a really important fundamental story for 2026.
And what does it imply for the market?
It implies that basically you're going to be able to get some roll down out of fixed income. So 25 will be the first year. The broad fixed income index is up 7.5% this year. First year we've gotten really good positive accretive returns out of fixed income portfolios since 2020, basically, like almost 5 years in a row now.
Let's talk about your action plan, because right now you say it's time to do a little bit of trimming. It's trim time, okay?
Well,
technology, communication services. So listen, I have a lot of experts who come in here, and they've come since this rally began in technology, and they keep saying trim, trim, trim. I'm like, by the time, over the last 3 years, you didn't have anything left to trim. Is there a formula for doing it?
There's a formula, we think, on valuation. So we took technology from a favorable in our portfolios down to a neutral weighting on October 30th, about 2 weeks ago, right? Ironically, the NASDAQ peaks on October 29th, so sometimes it's better to be lucky than good, right? But regardless, we just got through the summer months and into the early fall. Valuations were overextended there. We wanted to take some of that profit, redeploy it other places because we thought it made sense.
Right. Let's talk about one of those places. You like the financials?
Yes.
Yeah. This is a story here.
Well, it's a multivariate story, and really you got a lot of defense mechanisms. One, that steepness of the yield curve we just talked about, right? Favors financials. Credit portfolios remain pristine. Capital ratios remain high. We do think 26, even though we hit the air pocket in 25, M&A activity picks up, capital market picks up, which favors investment banking activity. So it's like check, 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 check into 2026, right?
You also like industrials and utilities.
Yeah, industrials very much a horizontal play to the AI, right? The build, the investment. In fact, we think the choke point of fulfilling some of that technology CapEx is really two things. Can I get the energy, and can I get the industrial companies to build at the pace and the rate that people are committing the expectations to?
And finally, on the commodity side, I want to pull that up as well, because you're looking for gold to sort of keep this rally going.
Yes.
4,600. And oil, West Texas Intermediate at 70. How does that happen?
Well, we're 64 today, right? Basically on Brent, right? A little bit cheaper on WTI. You're talking about an 8-9% increase. OPEC's been flooding the market, as we know. The U.S. has been pushing supply out there. We don't expect that to to mitigate in the first part of the year, but by the second half of the year, we think the supply.
Will any of this have to do, though, with the backdrop of a greater economic activity as well, or this is all policy driven?
We're actually quite bullish into 2026. We think, the fiscal tailwinds. We know the direction of monetary policy. You can debate how often and how much they're going to cut. Right. You know the rules you're playing with. You know that you're going to ease financial conditions. Right. Corporate profits, as you know, are off the charts. Right. All of that's leading into a good economy into next year, and that's going to push oil prices up, even if supply demand doesn't fully balance.
I got you. And those margins are looking phenomenal too.
They are.
Good stuff.